have a home bias. I mean, 50 years in existence. I mean, we've still got 45% of our real estate AUM in the order of 30 billion in Germany, plus the core European countries. And really my task is to globalize the portfolio. So we have an allocation over the next, we always do 5-year plans, maybe a very German thing to do, 5-year plans, you know. The point is we don't stick to them. Yeah, East Germany stuck to their 5-year plans, and we know what happened to them. We revise them annually, but we have one trend, which is to internationalize the portfolio, and we have a 55%, if I want to bore you with figures, allocation in kind of in my universe, which is Asia Pacific, the Americas, North, Latin, South, and UK. So the bulk of the money is going to go to sort of markets which are outside the Eurozone. And the shocking thing is, of course, it's not because you're traveling to Australia. We've just last year we bought a project. We forward funded a project in Brisbane, in Queensland. It's not that if you allow for hedging and all sorts of foreign currency effects, that you suddenly have a far higher yield because you travel 20 hours to get there. So it's actually getting compressed and expensive all over the world. It's really the diversification effect, the kind of the different cycles, because yields have compressed all over the place. And we as core investors, we don't want in our portfolios the volatility of currencies coming in, and we've just had an enormous oil price volatility. We have currency fluctuations which are enormous. So if we hedge these out, we actually pay quite a lot of money. So that brings yields into a core level all over the world, really. But the idea is to actually be more international, to globalize, and to get away from this home bias, which we currently still have. If you go to the gateway cities in the US, you pay enormous amounts of money. You can't get anything in Manhattan these days, and San Francisco, we just bought something, but it's still very pricey. So it's not rocket science to go for a secondary cities approach, you know? And I can prove it. We've designed the secondary city strategy for the US, and then we bought in Austin, Texas, in Minneapolis. So strategy first, then execution. In the UK, we've done this for years. I mean, we own properties. We just sold one in Cardiff. I mean, we own properties in Birmingham, Manchester. So we actually moved away from London, where we were actually pioneers in the early 90s. I think Union Investment at the time was branded DIFA, bought at 8.5% cap rates, you know. Fully stabilized buildings. That was the good times in 1991, for example. So we moved out into the regions or the secondary cities. I mean, you could argue Houston, Texas is also, well, it's a gateway city, but it's not the top tier like New York or Chicago. We spent almost 500 million US on a building full of energy tenants. Which in the oil price slump is quite something. So it's moving away from the tier 1 cities into tier 2. And secondly, to actually do joint ventures. We've recently bought 50% of Nomura Bank's European headquarters here in London, Watermark, which is a joint venture with Oxford Properties from Toronto. So to actually not only talk about joint ventures, but actually do them is a second tier of our approach. And finally, we've always been good at forward funding and forward purchase of buildings which don't exist yet, which in our peer group is not everybody's cup of tea, because some people just want to see the asset they're buying as it stands there and do the due diligence. We actually pay in down payments as construction progresses, and we do 40% of our annual spend of 2 to 2.5 billion with forward funding, forward purchase deals. It's these three strands which I think help us to continue to grow the portfolio outside of Europe.